Right now, Applied Digital Corp is trading at $33.99. That's up a staggering $4.70 on the day, a gain of over 16%. Now, when you see a move like that, a 16% intraday surge, the immediate assumption for a company with roots in digital assets is that Bitcoin must be flying. But that's not what's happening here. The story today isn't about crypto. The massive inflow of capital we are witnessing, the kind that pushes a stock up this aggressively, is because the market is being forced to reconsider what Applied Digital actually is. This isn't a simple momentum trade. It's a fundamental repricing of the company's entire future, and most of the market is only just now starting to catch on. The expectation for a long time has been that Applied Digital is a proxy for the crypto space, a company that provides hosting for Bitcoin miners. You see its ticker, APLD, and you think of volatility. You think of a business whose fate is tied directly to the price of digital currencies. That narrative suggests its value should ebb and flow with crypto sentiment. But the reality, the one that is fueling this 16% climb, is that Applied Digital is rapidly becoming a critical infrastructure provider for the artificial intelligence sector. This isn't about mining anymore, it's about computing. It's about providing the high-density power and cooling required for the kind of complex AI workloads that companies are scrambling to deploy. Let's break down today's price action. A move of this magnitude doesn't happen in a vacuum. The trading volume is immense, far exceeding its daily average. This isn't just retail investors on platforms like the Robinhood app chasing a hot stock. The size of the buy orders suggests institutional involvement. Portfolio managers at firms that use sophisticated platforms like interactive brokers are likely building positions. They see the strategic shift and are acting on it before the story becomes common knowledge. This is a classic case of smart capital moving in. The expectation was that APLD was a speculative play, something you might trade on SoFi for a quick gain. The reality is that it's now being evaluated as a long-term infrastructure asset, the kind of holding you might find within a growth-oriented strategy at Fidelity Wealth Management. The immediate catalyst for this reevaluation is the company's recent announcement of a major agreement for its AI cloud service. They secured a deal with a massive, albeit unnamed, U.S. hyperscaler. This isn't a small pilot program. We're talking about a multi-year contract that validates their entire pivot to high-performance computing, or HPC. The market is realizing that APLD has successfully landed a whale, proving their technology and operational capability are up to the standards of the biggest players in tech. This single event changes the risk profile of the company. It's no longer a theoretical bet on a strategic shift. It's a proven business model with a top-tier client. This is why the stock isn't just up, it's gapping up on enormous volume. It's the market digesting new information that fundamentally alters the company's growth trajectory. Think about the broader context. The demand for AI computing is exploding. We talk about NVIDIA stock and its incredible performance, but NVIDIA makes the processors. Those processors need a home. They need specialized data centers with immense power and advanced cooling solutions that traditional facilities can't provide. This is the problem Applied Digital solves. While everyone else was focused on their crypto hosting origins, they were building the next generation of data centers specifically for this purpose. This is where the expectation and reality diverge so sharply. People saw them building a data center in North Dakota and thought crypto. The reality is that they were building a highly specialized HPC facility perfectly suited for AI. Their ability to secure a major contract shows that they aren't just building on spec, they are building for a known massive demand. This makes their business model far more durable than the market had been giving them credit for. for. It moves them out of the highly speculative bucket and into the secular growth bucket. Of course, online investing always carries risk, and a small cap name like this will have more volatility than, say, Apple stock. But the nature of the risk has changed. It's less about the price of a digital asset and more about their operational execution in one of the world's fastest-growing industries. Investors using platforms for self-investing are now looking at APLD and comparing its potential not to other crypto miners, but to data center REITs and other AI infrastructure plays. So what does Applied Digital actually do? At its core, it designs, develops, and operates data centers. Initially, their focus was on providing co-location services for digital asset miners. This meant they provided the physical space, power, and cooling for other companies to run their mining hardware. It was a good business during crypto bull runs, but inherently cyclical. The strategic shift, which has been underway for a while but is only now being recognized by the market, is their move into HPC data centers. These aren't your standard server farms. An HPC facility for AI requires an incredible density of power and a sophisticated liquid cooling infrastructure to handle the heat generated by thousands of high-end GPUs like those from NVIDIA. Applied Digital has been building these next-generation facilities, and that's the key. They aren't retrofitting old centers, they are purpose-building them for AI workloads. This is a crucial distinction that many people missed. The capital they raised and the facilities they built weren't just for a volatile industry, they were an investment in the backbone of the AI build-out. Their business model now has two prongs: the legacy but still operational digital asset hosting, and the new high-growth AI cloud and HPC co-location services. The latter is clearly the future of the company and the reason for the market's sudden excitement. Many investors looking for investment help or using tools like Schwab Intelligent Portfolios might have overlooked APLD because of its crypto association, but that is changing fast. Looking ahead, the future outlook is now framed entirely differently. The primary catalyst is the continued insatiable demand for AI compute capacity. With one major hyperscaler deal signed, the door is now open for more. They have proven they can deliver, which significantly de-risks the sales process for future clients. They are no longer selling a concept, they are selling a proven solution. This puts them in a prime position to capture more of this demand. The market for AI infrastructure is not a zero-sum game. The pie is growing so rapidly that multiple players will succeed. Applied Digital's opportunity is to carve out a niche as a specialized, agile provider for these extremely demanding workloads. However, there are significant risks to consider. This is a capital-intensive business. Building these advanced data centers costs hundreds of millions of dollars. The company will likely need to continue to access capital markets to fund its expansion, which could lead to dilution for existing shareholders. Operational risks are also high. Managing energy procurement is critical, as energy is their single largest operating cost. Any spike in energy prices could squeeze their margins. Finally, competition is fierce. They are not just competing with other smaller players, but with giants like Amazon Web Services, Microsoft Azure, and Google Cloud, who are all building out their own AI infrastructure. While APLD is selling to some of these players, the competitive landscape is complex. Investors using an individual brokerage account through a provider like Fidelity Brokerage must weigh this immense opportunity against these very real execution and financial risks. Comment below what percentage of your portfolio you think should be allocated to high-growth, high-risk sectors like AI infrastructure. The path forward for Applied Digital will be fascinating to watch. The best-case scenario is that they successfully execute on their current and future contracts, build out their HPC capacity on time and on budget, and establish themselves as a go-to provider in the AI infrastructure space. If they can do this, the current valuation could look look incredibly cheap in hindsight. The stock would transition from a speculative trade seen on Robinhood stock to a core holding in growth-focused portfolios using a variety of investing sites. The comparison to Nvidia stock isn't about market cap, but about being a key enabler of a massive technological shift. The worst-case scenario involves execution missteps. Delays in construction, cost overruns, or an inability to secure favorable energy contracts could hinder their growth. If a major economic downturn were to cause their large customers to pull back on capital spending, that would also pose a significant threat. The reality of their situation is that they are at an inflection point. They have a validated business model in the hottest sector on the planet, but they are still a relatively small company trying to execute an extremely ambitious plan. The trading activity you see through the Fidelity mobile app or Interactive Brokers trading platform reflects this tension between massive potential and significant risk. In conclusion, the story of Applied Digital today is the perfect illustration of expectation versus reality in the market. The widespread expectation was that of a volatile, crypto-related company, a business whose fortunes were tied to an unpredictable